Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Taking a look at Nike this morning. Stock is up 4.5% after their Q1 earnings call. I last did a video on this one maybe in March. I think my price target there was like 55 bucks. It did hit that, but it hit it in April when everything was down, so it's not that big of a deal. Looking at the earnings today, they are better than I expected, so I can see why the stock is up. I think the expectations here were that you were going to see negative growth in Q1. They're actually flipping that into the positive, which is nice to see. Diluted earnings are down, margins are pressured, but I think everybody sort of expected that. That's not a surprise for anybody, but they are doing a pretty good job of getting back to the areas that they said they were going to focus on. Those areas were going to be North America, wholesale, and running. So if you look at the growth there, it was actually pretty solid. North America revenue was up by about 4%. Wholesale globally was up by about 5%. And then running was a standout performer for them, up about 20% or so. So really the strategy to focus on certain areas and make sure those are doing well, getting back to the wholesale focus over the direct to consumer focus seems to be working for them because they are moving in the right direction faster than people expected. They have this new strategy focusing on sport instead of brand. So it's not just going to be Nike, Converse, Jordan brand. It's now, what are we doing in running? What are we doing in basketball? What are we doing in football? What are we doing in apparel? And they're really focusing on those areas and kind of getting back to growth. And that seems to be working relatively well, at least initially. There's signs of life here, which is happening faster than I expected. But there are still some negatives that you get in these earnings. And that means that the turnaround will probably take a bit of time. And the negatives aren't a huge surprise. They sort of mentioned them last year as well when they were shrinking by about 10%. So that's one thing to keep in mind. Last year's revenue growth was negative 10%. So being up 1% off of a baseline that's down 10% from the year before isn't all that amazing. It's better than what we expected, which was going to be kind of bad, conditional shrinkage, but it's still kind of bad versus what Nike was in 2023. It's going to take them a bit of time to even get back to like fiscal year 24 revenue, I think, because of the pressures they're seeing on the digital front. So Nike direct revenue is down about 4% on a reported basis. If you look at global digital sales, they're down about 12%. Nike Direct in stores is doing a bit better, but digitally kind of struggling there. And a lot of that is just less focus on promotional activity. So they're trying to sell stuff at full price, which is good for the brand health long term. But in the short term, if people have gotten used to stuff being 30, 40, 50% off, maybe they're not shopping as much online as they used to in the past. And also there's a lot of competition there. Yes, running is up 20% here, which is good to see, but there are also a bunch of emerging competitors that are just giving people a lot of other options in a variety of areas, whether it's running, whether it's apparel, whether it's football or what have you. So I think they are kind of in the spot where they're already a very mature brand, and it remains to be seen where they go from here. This is kind of it for Nike, and they're sort of going to tread water, maybe grow at inflation or something in that realm, or can they expand further from here? Because the market is still pricing this relatively aggressively in terms of their actual current earnings. I think the expectation is one, that they return to growth, and two, that their margin compression is sort of a short-term thing. And if that's not the case, then these prices could still be relatively expensive. Because the margin compression is a pretty big issue for them. Gross margins down 320 basis points, diluted earnings of 49 cents, down about 70% from last year. There's an increased tariff impact here, which has increased from 1 billion to 1.5 billion based on some of the new tariffs. That's going to impact 2026 gross margin overall by about 120 basis points. That's off of 70 basis points that they announced before. So there's continued pressure. And really on the call, they talked about how that is going to pressure margins for longer than they expected. There was a question on the earnings call about, when are you going to get back to double digit margins? Right now they're in the mid-single digits, and again, this is a company that has had double-digit margins in the past, and they said it's probably going to be longer term. They also talked about how there's struggles in Greater China. That's really one of the things that is pushing their growth down. North America is pretty good. EMEA was pretty good. Greater China down about 9%, 10% on a constant currency basis. So that's kind of trouble for Nike in that area. They're really seeing declining store traffic, some underperforming sell-through seasonally, and really a marketplace that's very, very driven by promotions. So there's a ton of brands over there, just like there's a ton of brands here. And those are very discounted versus what Nike offers. If they're trying to focus on full price stuff internationally as well as in North America, is that going to work in a country like China that might now be focused more on savings than brand names? And there's also other brand names in China that are emerging as well. That's really Nike's issue in my mind. They're such a mature brand already. Where can they go from here? And the other thing is, right now, some countries, some people don't love what America is doing, politically or otherwise. And does that mean that's going to impact sales of a brand like Nike, which is very much a classic American brand that pretty much everybody knows? If you sort of think about Nike, you think about McDonald's, some of these marquee brands that have marquee names, does that lead to international underperformance? It's not really showing up in EMEA, which is good for Nike, but it's certainly showing up in Greater China. But I think a lot of that is mainly due to how promotional that marketplace can be, and maybe the allure of American brands in general just wearing off in favor of emerging Chinese brands that are just going to be much cheaper. And then brand-wise, Converse is another one that's struggling a bit. I think they're sort of resetting that brand down to about 27%. It's a very small part of their business, but obviously impacting what they're doing over there. And if you look at their EBITDA, their earnings before interest and taxes, Greater China down about 25%. So a lot of that negative growth is coming from Greater China, coming from Converse, and obviously coming negatively everywhere because of a lot of these margin pressures, including tariffs. Nike is still an awesome brand, but it is down 21% in the last year, maybe a bit less after today's bump, down about 7.7% annually in the last 3 years, down about 10% annually in the last 5 years, and basically flat in a 10-year investment cycle. So if you add dividends, maybe you're up about 3%. So it's been a pretty poor investment in the last 10 years. Maybe that means it's an interesting investment now, but it's still kind of expensive on a pure valuation model. So as we look at the valuation disclaimer, this video is purely for informational, educational, and entertainment purposes only. It is not investment advice. Nike's sitting at about $100 billion market cap. They have a pretty good balance sheet, about $8 billion in cash, about the same in debt, some capital leases. On top of that, if you look at their 2025 actuals, they're trading at about a 3% free cash flow yield based on that. So if you look at it that way, it's sort of in line with historical norms for Nike. Nike has always traded at a premium, kind of in that 3% free cash flow yield range, which is, depending on when and where the market is trading, kind of expensive, kind of cheap sometimes. But obviously, because it's traded that way, because it's always been expensive, and the results have been negative recently, the 10-year, 5-year, et cetera returns are just kind of mediocre as margins shrink. If you're buying something that's expensive in 2019 and then margins shrink and then revenue growth is barely there, you're not going to get a fantastic return out of that. They have been buying back shares kind of annually, somewhere in the neighborhood of 2 to 4 billion a year, depending on the year. There's about 5 to 800 million in stock-based compensation in the last couple of years that offsets that. They do pay a dividend, about 40 cents per quarter right now, kind of assuming about 6% growth in there. But if you look at what they're paying versus the cash flow they're generating the last couple of years, they're kind of getting close to sort of a full payout. They generated about $3 billion in free cash flow in 2025, paid about $2.3 billion in dividends. They're probably going to generate less than that in 26, maybe pay out close to 100% of their free cash flow as a dividend. That's because there's this short-term pressure on margins because of tariffs, gross margin pressure, increased costs, et cetera, and they haven't covered that off on pricing yet. So we'll see what they do with that. I think if you're an investor in Nike, you sort of have to expect, 2026 is going to be kind of mediocre. I'm sort of assuming that it's going to be a bit better than what the estimates are for 2026, fiscal year 2026. Then as you move in 2027, some return to growth, maybe a bit more growth in 28, and then kind of normalizing back into that inflation +1%, +2% range. If you want to play around with the spreadsheet, hit follow, make a copy. I will link it in the description down below. If you look at margins starting at 5%, going up to 10% by 2030, fiscal year 2030. If you look at these free cash flow yields at 3%, kind of where historically Nike has been, but also you can look at this and say, well, this is a company that's temporarily embarrassed, essentially, that these margins aren't going to be this way forever. So you look at a $3 billion free cash flow generative company in 2025. Really, if tariffs weren't around, if they weren't struggling because of various issues, they would probably be generating 5 to 6 billion in free cash flow on this number. And that means the free cash flow yield is closer to 5%. So if you feel that way, if you feel like this is a short-term blip and you think the right number is 3%, then based on the normalized free cash flow, yes, maybe Nike is cheap. I don't know if I feel that way. I feel like this will be a longer term issue for them, whether it's the China problem, whether it's the tariff problem, potentially their inability to kind of raise prices to offset those tariffs because of all the competition out there. Them focusing on less promotional stuff means there's going to be pressure on the top line. Maybe that'll mean good things for the bottom line, but it remains to be seen. Certainly, they're speaking as if this margin pressure isn't going to be something they're going to fix this year or next. It's probably going to be a longer term issue. So that's how I have it laid out here. If you disagree, you can certainly just play around with these numbers. I will link this down below. File, make a copy to use it. Most of the free cash flow going towards dividends. They are a dividend payer, growing that at about 6%. 40% of the money going towards buybacks, offset by stock-based compensation, does have a positive buyback yield. What's the right valuation for this? Because of the struggles, I'm putting it at 4%, a 4% free cash flow yield. Last time I looked at this, I had it at 4.5%, so you can change that as well. Gets me to an expected return of about 8.7% based on these assumptions. Are they too aggressive, too conservative? Let me know down below as a comment if you agree or disagree. That's not bad. You know, if you're a bit more conservative and you look at a 5% free cash flow yield, it's only a 4.7% return. If you're a bit more aggressive and you feel like Nike is going to return to the Nike of old and should be valued at a 3% free cash flow yield because of the brand name, the cachet, etc., you get a 14% target return. So I get why people are investing in this. For me, apparel companies aren't all that exciting. You know, if they get cheap enough, I'd be interested. For Nike, you know, cheap enough would be, hey, if I'm looking at a 8% target return, gets me to about 10.3% after the dividend, gets me to a fair value of $64. If I want some more, maybe a 10% target return with the dividends, about 12 and a half, gets me to a fair value of $58. That's kind of where I'd get interested in Nike again, like how I was interested in Nike in the 50s. I never ended up buying it then because there were just more opportunities in April that looked more interesting, whether it was Google or some of the other tech names that were down 20, 30% at that time. Nike was down as well, but it was still just an apparel company. Yes, it's an awesome brand name, but it's clearly one that's going through some struggles. They do have some new leadership at the helm that seems to know what they're doing, that seems to be turning around quicker than I expected. So that's why the fair value is up a bit from the last time I looked at it. However, it still remains to be seen what happens here. You know, when you go from growing in the mid single digits at least and having 12% margins to suddenly falling by 10% and your margins compressing to half of what they were before, that's a bit panic inducing as an investor. So it's not cheap enough for me to sort of stomach that in my mind. If they can turn it around, if they can take this back up to, let's say, 12%, then this is going to be a really solid investment. You're talking about low teens, mid to high teens even, but I'm just not sure they're going to get there just yet. I'll probably have to see another round or two of earnings to get a better idea. I can see why people are buying this. I can see why people are liking it. It's just not for me at the moment. If it drops a bit, maybe it gets into the 50s, I'd probably be interested then. But right now, it just looks like an okay investment. So what do you think? Am I wrong here? Am I missing anything? Let me know down below. Comment, like, and subscribe and all of that good stuff. And stay tuned for more videos. Bye.